Hey, what's up, stock compounders? Brad here. So today we're going to do a question and answer session. So the first question comes from Sean, who left a comment on one of my videos recently. Why is Mohnish Pabrai your number one mentor over Warren Buffett, Bill Ackman, Seth Klarman, Town, Guy Spier? Obviously, there's a lot of great investors. Why have I really honed in on Mohnish Pabrai? And then he asked, what is the single most important characteristic, philosophy, style that is more appealing about Pabrai than the others? Well, honestly, the reason I follow Pabrai, as compared to Buffett, so Buffett is managing so much money for Berkshire Hathaway that the number of investment opportunities that he can look at is actually quite small because he's only looking at the largest public companies and private companies, because in order to move the needle on the Berkshire Hathaway portfolio, it has to be a pretty large company. It's just not worth him spending time looking at smaller opportunities. And obviously for me, I want to be looking at the whole universe of companies to find investment opportunities. So that's quite a limitation of, cloning someone like Pabrai. They say a fat wallet is the enemy of high returns. So that's my answer for Buffett. The one thing I really like about Pabrai, he has a very concise focus in terms of what he's looking for. He wants to find opportunities where he can pay 50 cents to get $1 in 2 to 3 years. Okay, so he's looking for companies that are going to double his money within 2 or 3 years. I haven't heard anything that concise actually from those other investors that were mentioned, and I really resonated with that idea of finding a dollar bill for 50 cents. And also, Pabrai just puts out so much great content. He really has an ethos of giving back to the value investment community. He picked that up from Buffett. And, Bill Ackman will do the occasional interview, but he's not going to business schools and doing guest lectures like Pabrai does. Guy Spier does some of that. But honestly, guys, I think Pabrai is a bit of a better investor than Guy Spier. I think his track record is a little bit better. He tends to make maybe fewer bets and bigger bets than Guy Spier does, and I appreciate that style. It's actually easier to clone. It just suits me. It suits my personality better. And then, I don't know a whole lot about Town. I haven't actually read his books, but I'm getting inspired to learn more about Town. And of course, Seth Klarman is a legend. If you haven't read his book, Margin of Safety, it's just fantastic. Don't buy the hard copy because it's like $1,000 on Amazon. You should be able to find the PDF version of Margin of Safety on the internet for free. So check that out. But yeah, really, if I had to sum it up, he has an amazing track record of returns over the last 25 years. And because he puts out so much content, particularly to students of business, I can wrap my head around his investment approach, his investment style. And that just makes me a lot more comfortable to clone him than some of the other investors where I can't really get in their head. I feel like I can get in Pabrai's head a little bit more than some of those other investors. So that's how I'll answer that one. Question 2. What would your advice be to someone who is about to buy their first stock? So really, I have a couple questions I'd encourage you to ask yourself if you're about to buy your first stock. The first one is, who's on the other side of this trade? Who's selling this stock that I'm buying? Okay? And is it more likely that I'm getting the deal here or that they're getting the deal here? Because anytime you buy a stock, someone else is selling, right? So I find it useful to consider, why would someone be selling this stock when I want to buy it? Another question I encourage you to ask yourself is, am I buying this because I want to own part of this business? Do I believe in the business over, the next 3, 5, 10 years? Or am I buying it because I think the price is going to go up? Because I've been looking at the past price history and I see something in that makes me think there's more likelihood that this stock is going to go up than it's going to go down. So, those are really fundamental to intelligent investing, those questions. Particularly the second one, why am I buying this? Am I buying because I want to be an owner in the business, which, is what a share of stock represents. It's a partial ownership in a business. Or am I buying because I think the price is going to go up? That tends to be a more speculative mindset. If you're simply buying and selling because of what the price has done or what you think the price is going to do. So, really gut check yourself on those questions. And I think that'll help. That'll help you make better decisions in terms of investing. Question 3, I thought of a real flaw with fundamental analysis. It's backwards looking. Can't things be very different in the future than they've been in the past? This is from Facebook group Value Investing. It's got over 100,000 followers. And I just thought it was kind of an interesting question of, yes, fundamental analysis, the only numbers we have for a business are from the past, okay? Since we don't have a crystal ball of what's going to happen in the future, it helps us to try to ascertain, what might happen next based on where the company has been. Of course, you can't predict exactly what's going to happen in the future of a business by looking at what's happened in the past. But it's really the same way you can judge someone's character. You can only judge someone's character by seeing what they've done in the past, right? The quality of their character shows up in how they've conducted themselves in the past. The future, nobody knows what the future is. And since nobody has a crystal ball, there's a lot to be gleaned by what has happened in the past when it comes to figuring out if a business is worth investing in. So of course it's flawed. Of course the past isn't going to be the same as the future. But there's clues. There's clues in the past about quality of management, about whether or not the business has a moat, whether or not it can kind of fend off competition. There's a lot of clues to be gleaned from the past. And we can't see the future. That's one of the reasons that even the best investors are going to be wrong at least a third of the time, because the future hasn't happened yet, and we don't know what's going to happen. There's many different outcomes that could transpire in the future. And investing is really about assessing the probabilities of those outcomes and only swinging at pitches when the probabilities of a lot of upside in an investment are higher than the probabilities of losing money. That's really the game, is to only swing at asymmetric pitches where there's asymmetric upside to downside. So I just thought that was kind of an interesting question. It threw me a little bit, and then I thought, well, maybe I can talk about this one. Question 4. So Warren Buffett claims PE ratio has nothing to do with valuation. Do you agree? A little context for this question. I thought this was, a bit of a leap from what Warren Buffett actually said. In his annual report in year 2000, Buffett said, common yardsticks such as dividend yield, the ratio of price to earnings or price to book value, and even growth rates have nothing to do with valuation, except to the extent that they provide clues to the amount and timing of cash flows into and from the business. Okay? So, yeah, you need to look at the whole picture, right? Price to earnings ratio doesn't give you the whole picture. You have to know the growth rate. You have to know the dividend payout. You have to know your required rate of return to discount those cash flows. You've got to know more than just the price to earnings ratio in order to figure out if a company is cheap or expensive. But where my mind went initially with that question, this claim that PE ratio has nothing to do with valuation, price actually has nothing to do with valuation. Valuation is all about, what cash flows can the business create from now until Judgment Day? And then what is the appropriate rate to discount those back to present value? That has nothing to do with price of the stock. And I think it's actually better to go into a valuation not knowing what the price is. Because as we see with analysts all the time, take Tesla for example, as Tesla sets new highs, you have analysts that are calling for even higher highs. And that's really because they're anchoring on what's happening to the price today. Okay? They're trying to justify their valuations based on the price. And that's really kind of a backwards way to do valuation, to start with the price and then kind of figure out what valuation inputs you need in order to come up with a value that's close to that price. That's not a very useful exercise as a value investor when really we're trying to find companies where there's a big difference between price and value. That's the margin of safety. So if you're going into a valuation trying to justify a price with your valuation, it's not going to benefit you. You're not going to, it's not good valuation work. So I think it's better to not know the price, which means it's probably better not to know the PE ratio before you set into valuing a company. Question 5, how do you deal with FOMO? How do you deal with FOMO? When your neighbors are making money hand over fist. I had a guy visit the other day here who, he owns a Tesla. He was buying into Tesla at $1,000 and a little more than $1,000. He thinks Tesla's going to the moon, right? I mean, probably most people right now think that Tesla's going to the moon. So how do you deal with that? If Tesla does go to the moon, how do you deal with missing out on that? There's probably a lot of people buying into Tesla now at like $2,000 a share because, well, it's gone from $230 a share like a year ago to $2,000. Where is it going to go next? So you guys have to realize that's investing, or that's playing the stock market based on price movements. Okay? That's not investing. That's speculating, like I talked about earlier. So the way to deal with FOMO is to clearly define the game you're playing. Okay? And you got to make sure the game you're playing makes sense, that it's been played by other people who are winning that game, have won that game. It's a game where there's somewhat clearly defined rules. Okay? And it's a game that produces great results over the long term. Okay, that's really what value investing is. So the way to deal with FOMO, just keep focused. Keep focused on value investing. Keep focused on finding companies where you can buy at a solid margin of safety. Okay, that's the game. Focus on that. And so your neighbor gets fabulously rich on Tesla. Say that happens. So how does that affect you? That's really, that goes into an exercise in, not having envy. So great. It just takes us into another realm of working on ourselves. Question 6, where do you put your money while you wait for the price to come down on a stock on your watch list? Okay, so I've got my money in my portfolio. A chunk of it is in cash. I'm waiting to find the next investment. What do I do with that money? It's just sitting in my portfolio. If I had a lot of money, maybe I'd put it in treasuries. Maybe I would find a high yield savings account to put it in. But those things are too much work for how much money I'm managing. It's just not worth it. And I want to make sure I have the funds available to deploy if there's a surprise that happens, right? If the price of a stock goes down really fast into my buy zone, I want to have money ready to buy that. Because I think, when I got started on Robinhood, it would take like 4 or 5 days to transfer money from my bank into my Robinhood account. And, that could be enough time to miss a great buying opportunity. If, say you got a company like Google, there's some surprise and it drops into my buy zone, it's probably not going to stay in my buy zone very long. Okay. So, that's my approach. I just have it in cash. But it's not like I'm leaving it in cash for years and years and letting it pile up. If that were the situation, I'd probably find some way to make a couple percentage points on it. But really, I'm doing things with that cash probably every 3 to 6 months. So it's not sitting there for a long time. But yeah, I don't have any need to try to get a few percentage points out of it until I can buy something with it. So that's my answer to that one. All right, guys, have any questions for me next week when I do the next Q&A? Leave them in the comments. It's great. This channel, it feels like it's kind of at a tipping point here where I'm getting enough questions that can sustain these Q&As just by answering the questions that you guys are asking, rather than looking elsewhere, looking on Value Investing Facebook group or Reddit or other YouTube channels to see what questions people are asking. So keep the questions coming. I'm excited to really cater these answers to things that you guys are wondering about. So anyway, with that, I will see you guys in the next video. Take care.